Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Recent data has shown that inflation remains sticky, which has added uncertainty to an already cloudy outlook for monetary policy. The question many are asking is, how does that impact investment portfolios and what can be done to help investors navigate that uncertainty? Well, I have on the perfect guest to help answer those questions. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions. I would like to welcome back Cliff Corso. Cliff serves as a president and chief investment officer of Advisors Asset Management. Cliff, thank you so much for coming on the show again. I'm glad I didn't scare you away after the first episode. So it's
No,
really an honor to have you back on to share your fantastic insights. Can you just
well, thank you.
start by telling us a little bit more about yourself and Advisors Asset Management?
Sure thing, Ryan. I've been in financial services for, I'm afraid to count it, but going on 40 plus years now. And I was just before the call with you here today, just adding up some of the major events that I've seen in the seat as a portfolio manager, credit analyst, chief investment officer, and founder of asset management companies. And now my present role is president of AAM and chief investment officer. Yeah, a lot of events, 5 recessions. I counted at least a dozen significant market moving events that have occurred, like Black Monday in '87, September 11th, so-called Asian contagion, long-term capital meltdown, housing market collapse, things, Great Recession, obviously COVID. And all those major events had impacts on the market. So I've seen a lot. I think just a couple of the lessons that I've onboarded along the way here is that the world can be an unpredictable place, despite all of our efforts, best efforts to control everything. It seems the 100-year flood comes every, I guess, 7 years or whatever that average is. But with a little bit of longer term perspective, prudent asset allocation, patience, and good portfolio construction, you can ride through those times, take advantage of those times actually, and build outstanding portfolio results. So just some of the lessons I learned there. AAM, just for the viewers who may be less familiar with AAM, AAM is one of the largest independent solutions providers to the wealth channel.
Okay.
We have a 45-year history working with FAs as a trusted partner. We are offering a broad array of investment solutions to the financial advisor that include offerings in fixed income, equities, and alternatives, and then as well across multiple different formats, separately managed accounts, mutual funds, ETFs, UITs, now alternatives and interval funds and non-traded vehicles that are growing within the alternatives market. And the punchline, Ryan, is we're here to help the financial advisor succeed in their practice and building great portfolios and helping them grow their business. And last year we were proud to say that we placed $36 billion of investment solutions across over 16,000 advisors' portfolios. So we thank all those out there who have worked with AM over all these years.
Great, Cliff. Thank you for giving us that recap. It's interesting that you said 40 years. So
Yes.
we, within Zephyr, we have the PSN managed account database, which houses 20,000 some SMA and managed account strategies. And it's reaching its 40-year anniversary this year. So I've done some content regarding that 40 years. And it's really interesting all the different obstacles that over the 40 years that you talked about that maybe you don't really think about it because recency bias and all that stuff, but through all those obstacles, I believe the S&P 500 has still returned over 11%. MSCI EFI I think is 8%. So it just shows you like patience and perseverance over the long term, it wins, right? And you just got to
Absolutely.
get through those obstacles. And like you said, there's a lot of opportunities there too when you see a 30-40% market correction.
Absolutely. You know, one of the keys, and you hit a couple of real important ones, is having a plan and sort of that long-term view can help take some of the emotion out of these events, because we're all people and we all have emotions, and emotions can bring us to the wrong place often. So just having that plan in place, having some diversification within the portfolio, and I think importantly, if you take that longer term perspective and build a durable portfolio during the tough times, if you can look to that portfolio to generate powder capital for the opportunity when it might have swung too far to the fear part of the bell curve, that allows you to really enjoy some spectacular opportunities riding through cycles. And really just a page out of Buffett's book. I do like his famous saying, be fearful when those are greedy and be greedy when those are fearful. That's very easy to say, very hard to do unless you have a plan and you're patient and you've built a portfolio that's durable, maybe bendable but not breakable. That's one of the keys.
I like that, bendable but not breakable. That goes along right there with the be fearful when people are greedy and John. I love it. I love it. So, and you're exactly right, Cliff. That's where I think AAM and Zephyr, we can help financial advisors, create those portfolios because it is so emotional and it's a behavioral decision when you're investing. Speaking of that, so inflation. Inflation again continues to drive market commentary. It just won't go away. It seems like we've been talking about inflation for decades now. Will inflation reach the Fed's 2% target, or is it going to remain stubborn? And what challenges does that bring to investors?
Yeah, our opinion, Ryan, on this one is that inflation, and it has been for the last 3+ years, is that inflation will remain sticky. Of course, we all expected it to come down from its peak. 9.1%, I believe, was the
Yeah.
peak of CPI, because of all the supply chain disruptions and things that ultimately would clear. But if you peel away under the hood a little bit here, there are some very significant drivers that we think will keep inflation sticky for quite a while. I mean, not months, but arguably years. Not 70s inflation. We're not necessarily we don't think we're heading back up too severely the curve, but maybe somewhere around this 3% plus inflation range. So it doesn't sound far away from the Fed's goal of 2%, but it is 50% higher than the Fed's goal of 2%. And the so-called last mile just going to be really tough. And I'll just give you two buckets to put that in. One is connected directly to the US and the dynamics in the US, that bucket. And the other bucket is global. In the US bucket, many drivers here, but I'll just pick two that represent upwards of 2/3 of CPI or inflation. One is maybe a little ironic and unexpected, and that's housing. The Fed can control or attempts to control demand. And the way they do that, of course, is by raising rates, making things more expensive in terms of borrowing money, and then trying to push down or slow down consumption in the economy. Housing, you would think, okay, that should be an easy one, right? Mortgage rates go up. That's the main tool. But ironically, what it's also done is it's not only created a blanket on demand, it's created a huge blanket on supply of housing. Because I think up until this event, many people hadn't focused on the fact that the lion's share of homes available for sale are existing homes, somewhere on the average pre-COVID of about 5 million units annualized. The small part of it is new home construction, pre-COVID about 500,000 units. So we've had a little bit of demand destruction, but guess what? Anyone out here, your viewers who maybe have 3% mortgages, it's sticky. It's not necessarily a liability anymore. It's a little bit of an asset because it's hard to replace that. So that's taken home supply way down. You still have demand. You still have a hot economy. And so, despite the high raise in mortgage rates, we still see pressure on housing. And but even before all this, Ryan, we were still 2 to 3 million housing units short, just structurally. So we've got a long way to go to seeing alleviation on the housing component. That's a third of CPI. And then wages. We also have a little bit of a dynamic there with demographics and aging populations. Now, we all know, we've all been reading about immigration, but we still have this secular challenge, particularly in a strong economy. Again, GDP, pushing upward of 3% here, and 3.8% unemployment rate. These are decades low. So those two things are 2/3 of combined of inflation. And then the second bucket is more global related, and we're not alone in this inflation stickiness. It's global. Energy is a great one. If you think about AI, I think about this and I say, well, AI should be, positive, increasing productivity over the long haul. That makes sense. But in the short run, is it inflationary or disinflationary? Because it consumes huge amounts of energy. Some of the stats that you'll see are that by the year 2025 and 6, it'll be responsible for 15-20% of energy consumption and up to 25% over 5 years. That's huge. We don't have the grid for that. Right. So that's inflationary. And then deglobalization and onshoring are inflationary. So I think I think we've laid out a case that we believe in that'll keep inflation at this 3% plus level for quite a while. And I think the Fed is getting used to the idea. I can't really say it because they don't want to destroy credibility, but around the 2% target. But this hope for longer, higher for longer, that's our view. And we think that has significant implications for asset allocation.
Very interesting. Thank you, Cliff. So I often thought you're right, when inflation was 9%, that first part reducing would be somewhat easy when you got rid of base effects and all that stuff. But now we're getting to where it's going to be a struggle to get down to that 2.5%. And just exactly what you saw. And with housing, how many people are going to want to replace or exchange a 3.5% mortgage for a 6.5%, 7% mortgage, right? Not very many.
Absolutely.
It's a tough one to, so that's going to reduce some supply there also. So there's a lot of things going on with inflation. Do you think it's going to normalize, like with rates? We're still getting the impacts from COVID and getting the after effects. When is that going to normalize, do you think, or will it anytime soon?
Sure. I think normalization is a great word, Ryan, because I think viewers may have heard, and we've talked a little bit about the regime change that we're in. We had the big regime change of lower and lower and lower rates to zero, and we stuck with that post GFC. I remember that day very specifically when one of the central banks dropped to negative rates. I didn't read about that in any of my textbooks. Take my money and I'll pay you, please. Hold
right.
But now we're in this new regime post-COVID of, obviously we shot the bazookas off again on monetary policy and fiscal policy. We've got debt to GDP of World War II proportions and growing rapidly. So we've got, this new regime, which portends this, what we've seen and we'll continue to see, the higher rate regime. But, I like the word normalization that you used, because a lot of what is going on in this quote regime change it's really returned to normalization. In my mind, Ryan, and again, having been in the investment world for 40 years, a 4.5% 10-year yield is not abnormal.
Yeah,
it's really not. And what was abnormal was the post GFC world where we had 2% and 3% 10-year rates, and that's because the Fed was artificially buying bonds and suppressing interest rates. So that's changed now. And so I think part of the challenge for the market, and you talk about recency bias, I think that GFC low rate regime is recency bias. And so again, I don't think we need to fear this return to normalization of, let's just call it a 4.5% average 10-year, because that is normal. And just put a little specificity on that. It's a rough calculation, but it holds, it holds true that the 10-year rate typically or historically over the lengths of time has sort of approximated real GDP and nominal GDP. And that's real GDP plus inflation.
Okay.
So if you think inflation's 2.5%, but your viewers can pick a number. You think inflation's 2.5% or 3% sticky, and the real yield or real GDP's expected to be around 2%. Just add those two numbers, 2% real GDP. Pick your inflation number. Let's use 2.5, and then that's 4.5% 10-year. I don't know that the market's completely focused on that, and that it's normal and it's okay. As long as it's stable, then we can go about our business. We can plan our investments and borrowings and all that. So that's going to take a little bit of time.
Right.
But normalization is a great word, right? And that's where I think we're heading towards. It's going to take time. It's a process. It's not binary.
Right. Right. Fantastic. What are some other risks or challenges you and your team are focusing on?
Sure. I think in this world we're in now, where we have this moderate sticky inflation,
Okay.
one of the things that we're seeing, and it flashes in and out, and I'll explain that in a minute, is correlations between asset classes. We all know or are familiar with the traditional 60% equities, 40% bonds portfolio. And that's done a great job. And now that rates are back up, we'll continue to do a solid job. But one of the challenges now one sees is that, and history would show you this as well, that in these stickier inflation times, not 70s, I mean, these kinds of inflation numbers, that stock bond negative correlation, meaning one goes up, the other balances it, and vice versa, and smooth that ride out, becomes a lot less predictable. And in fact, there's some work done, research done, and you can see this in various publications, that the rolling correlations pre-global financial crisis and in those slightly stickier inflation regimes are actually not negative. They're actually positive. So you don't really get that ballast that you're looking for in as predictable a way. And we're not saying don't buy bonds. We'd be believers in bonds for sure. Good income generators and do provide ballast, but maybe a little less predictable. So what we're seeing and what we're recommending is diversification beyond equities, fixed income, and beginning to add some alternatives into the portfolio. Ultimate goals, perhaps depending on one's risk tolerances and time horizons, could be something like 50, 30, 20 equities, fixed income alternatives. And we think that's a good recipe for building durability within the portfolios, not sacrificing growth opportunity and not sacrificing income generation.
Right. So, there's a lot of talk about the 60-40 being dead, and a lot of it was because of higher correlation, right? And correlation increases, it kind of makes that 60-40 mute. But you're right, the alternative. So while 60-40 may be dead in a way or on life support, I've said, it's just a matter of just reimagining 60-40. And like you said, maybe adding alternatives to it.
I think that's exactly right, Ryan. Not abandoning those two buckets per se, but just further diversification within those asset class categories can enhance yield across the portfolio, bring down volatility, add a little bit more income, because the private markets and alternatives tend to offer a little bit more return opportunity and income, a little less trafficked and other drivers. And so you build just a stronger portfolio that can handle volatility a little bit better, but without sacrificing return. In fact, enhancing return to the portfolio.
Yeah, and studies show, I've done some studies within Zephyr that shows, you add, and it doesn't have to be a lot, 10% alternatives, and that efficient frontier of optimized portfolio shifts to the Northwest, right? So you get higher returns, lower risk, just like what you're talking about. You've mentioned you believe there's a generational opportunity in alternatives. What sectors are you particularly bullish on?
Sure, and alternatives can mean many things to many people. But what we look toward are sectors that we think are most impactful to portfolio allocation first. Second, are not that are scalable, meaning that they can be broadly available. Do those good, create those good properties within portfolios, but not just for a small group of folks, because they're very, very niche, but a little bit more broad and scalable capabilities. And areas where the alternative opportunity is growing for whatever reasons, could be regulatory reasons, like in private credit, where the banks are still being guided away by regulation from lending, and private lenders are coming in to fill those gaps, and great opportunities around that. So we like three areas in particular that fit those parameters, and one I just mentioned, which is private credit and direct lending. I mentioned the banks pulling away, and you read and remember about the community banks and SVB and all those banks having challenges. And so again, lending continues to shrink in the bank channel. And I know because I was a bank lender back in the 80s, and has been shifting since then, by the way. Just to give you a sense of scale there in terms of the growth opportunity, i.e., it's an asset class that's not small. So it actually probably shouldn't be ignored. Big asset class, as large as small cap, actually, in direct and private lending. You have a nearly $2 trillion market growing at a very, very strong compounded annual growth rate for those reasons. And the benefit of it in private credit, a few benefits. One is you tend to get offered, first, you're at the senior part of any company's capital structure, meaning you have equity, which is at the bottom of the capital structure. You have unsecured debt, bonds, and the like, next level up. Then you have direct lending, and that is senior to all those other components. You would say, well, then you must be earning less than high yield bonds. Actually, more often than not, you're earning more because, again, it's a less trafficked market. And because it's a private market, they tend a lot of the private direct lending tends to be privately bilaterally negotiated. So you offered a lot of really powerful return and yield enhancement, typically maybe upwards of 3% more than you'd be offered in more broadly syndicated loan market, bigger market, or within the high yield bond markets. So that's a powerful property. The second is they tend to be floating rate, meaning if rates are, as they have been going up, the rate will float up with it. And if you think and take a step back, our view here at AM is a higher for longer. But even if you want to debate that a little bit, and you say, okay, well, maybe rates will come down. Again, think about what we were talking about earlier about normalization. A 2% Fed funds rate, which is where the floating rate, is pegged off of, wouldn't be normal. It'd be more like 4%, actually. So, even if you want to turn a little bit of a harder eye on the a higher for longer, it's still a very powerful dynamic. And again, at the senior part of the cap structure. So I think it's a great risk-reward equation in a growing asset class. Another one would be infrastructure. Okay. We read a lot about the Inflation Reduction Act and CHIP Act, and we read a lot about AI, and what's important around all those things that I'm mentioning is that our infrastructure is, a lot of this is geared to building and growing our infrastructure, the backbone not only of our country but the world. Yeah. And so infrastructure is critically important. We particularly like the sustainable parts of the infrastructure world, where we see a lot of the secular tailwind, and those be things like wind and solar and power. Not to say that the existing grid of fossil fuels, also is we think energy complex positive, but within that energy transition and sustainable world, we're just getting started. So we like that area a lot. It definitely provides diversification. Yeah. And as well, a good inflation hedge, because a lot of these infrastructure projects are pegged toward resetting rates, contracts as inflation perhaps moves up. The third, I think might be a slight surprise, perhaps, and that's real estate. Now, everyone is talking about, not everyone, but many talk about real estate as if it's one sector. When in fact, it's many different subsectors of the market. Yep. And an area we particularly like, a couple of areas we particularly like, are data centers. Yep. And industrial. And again, they actually kind of connect back to the previous theme of the way the world is changing. You think about reshoring onto the United States platform here. We need warehouses. Everything we almost see here on the screen or around our office or home we came through a warehouse in some way, shape, or form. And the warehouse, particular segment of the warehouse market or the industrial market we like is newer, because that's going to be right at the forefront and tip of the spear for what is required in this new world. So, real estate, data centers, what's interesting there, AI, just hitting that theme again. I think we all know it's not going away. It's going to be quite an interesting journey. But huge consumers of energy, data centers, housing, all the equipment, the things that are required. So, you have a huge secular tailwind. And what data centers need nearby are land, of course, water, because they generate a lot of heat and power. And so those players in data center construction and operation, I think, are going to be real winners here. Those are three that we like as among the list of other alternatives.
I love it. Yeah. Alternatives, like you said, there's just so much to alternatives, right? It's a huge asset class in itself and all the different subsectors. And then, like you said, REITs. I think so many people don't think about all the subsectors underneath REITs. They just think of, office space, and it's like, oh my gosh, I don't want to get in the REITs. All the buildings are, being sold at $30, 30 cents on the dollar, and all this stuff. But there's a lot of opportunities just within that REIT space. And you talked about accessibility to alternatives. I think accessibility has improved. Advisors have historically run into issues when trying to offer alternatives to their clients. What kind of investment vehicles help dismantle those hurdles?
Sure, and that's a key point because institutional investors, endowments, foundations, pension funds have been tapping and utilizing alternatives for the better part of 25 years plus for all the reasons that you and I had just touched upon. And but they were just painful, for lack of a better description, for the wealth market to access, because the more traditional institutional vehicles require very long lockups. It could be 10 years plus. Require a little bit of uncertainty around when you actually have to put the money in. Often it would take long periods of time to, if you committed $100, for example, it wouldn't all go in right away, and you'd be subject to the capital call, so-called capital call. And then as well, it would be limited partnership accounting and taxes. So all those schedules are delayed, and it creates a little complexity. There's been a democratization that's gone on with new vehicles and that are specifically designed to alleviate those pain points. And some of the terms that you'll hear and read about would be non-traded perpetual vehicles. So that would be a non-traded business development company, or BDC, or a non-traded REIT, or an interval fund. The commonality around all these are that they've simplified the taxes, so it's 1099 reporting. They're a registered product, so you have transparency around the product, and they come with certainty of investment, meaning you don't have to wait, and whatever dollar you want to allocate, you invest it today, and they generate returns, from the moment you're putting your money to work. And so again, it's very much simplified structures. And that's been a big part of the growth story within the wealth channel for alternatives. And if you think about our partners out in the market, our financial advisors and the firms that are from the wires to the RIAs to the bank channels, that they all have significant interest in trying to move the portfolios to the principles that you and I talked about, a little bit more diversification. So that's a secular, it's a secular and therefore generational opportunity. It's still very early days, albeit there's been a significant amount of activity. So still a lot of opportunity. And again, it's just removed a lot of the pain points for the wealth investor.
I think I know what the answer to my follow-up question will be based on the improvements of accessibility, like interval funds. But do you believe private markets will continue to grow in popularity amongst high net worth individuals?
I do, Ryan. I think because of the dynamics of how these private markets are secularly changing. And again, just to touch one last time on the private credit market or the direct lending market, it's growing exponentially because it's filling a needed gap in the market. Private lenders tend to be nimble. There's capital that's obviously behind it all, backing the loans. They tend to be good partners to the sponsors and the companies that are borrowing. So I think that continues on growth, real estate, and just new areas actually.
Yeah.
Ryan, one your viewers may have been reading a little bit about. We're exceptionally excited about it as well as sports as an investment opportunity,
Oh,
and not for vanity, not so I can show my Super Bowl ring off, but it's really because it's really because that whole world is emerging and evolving in such interesting ways. And if you looked at the women's basketball, it had more viewers than any a men's equivalent of the basketball game. So soccer, professional bull riding, sailing, Tiger Woods has a new league, TGA. It's a fascinating space,
mm,
and it provides a lot of the principles that we've talked about: diversification, good growth opportunity, an emerging sport. So I think we're just getting started on alternatives. There'll be some areas that maybe challenge. I won't particularly pick any out, but I think where you look at where there is ability, where there is interest, where there's potential scalability, where there a professional focus on those asset classes, both in terms of the wealth channel as well as asset managers or operators. I think you'll continue to see this secular shift toward alternatives growing and expanding. And I think
mm.
that's going to be really fun to watch over the next decade too and beyond.
It's interesting you brought up sport. So you're not saying you're going to start investing in the Green Bay Packers and become a shareholder of the Packers.
Well, what's interesting about that is I think so many leagues institutional investors can invest in, some not yet, but it's changing, and more leagues are allowing minority interests. As a regulated industry, minority interests within. So, within a fund, one might be able to say, fill in your favorite sport. I own a piece of the stadium or
Yeah.
this team.
Yeah, it's interesting. And I keep hearing I'm a huge college sports fan, and with all the money that's just being tossed around with these TV contracts, private equity, I keep hearing, and VCs kind of getting involved with it too. Just
Yes,
the amount of
yes.
money that is being brought in.
Yeah, I learned this over the last several years, just focused on this part of it, is that if you think about our lives, and certainly I'm maybe a little older, but way back in the day, the shared experience was we had three channels. So you'd come home from school and you'd watch one of three channels, and you'd come back to school the next day, and you could talk about it. Oh, did you see fill in the blank or Roots or whatever show you? Today it's so spread out that shared experience is very fractured. Sports is one of the few live sports, one of the very few shared experiences globally that we all can have as humans. And I think that's a really interesting dynamic within sports. So the fact that you can invest in it, it makes it maybe a little bit more interesting.
Right, right.
But it's a powerful, powerful human connection. Live sports.
A lot of our listeners or a lot of people might be out there saying, I already invest in it, Cliff. I gamble, so I'm investing in it. But
Indeed.
anyways, Cliff, such a fun conversation. Thank you so much again for coming on the show. It's such an honor. You always have such fantastic insights to share. Where can our audience get more information about Advisors Asset Management?
First stop would be your financial advisor representative at AAM if you have one, or if not, you can go to our website aamlive.com. I appreciate lots of good information on there, lots of good white papers, and hopefully I think your viewers would find that useful.
Yeah, I go there often. Your team, yourself, you guys produce a lot of great thought leadership. I love it. A lot of good resources there.
Thank you.
So, thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you and have a good rest of your week.